Welcome to this supplemental lesson by Third Decade. We will be covering how to calculate how much you should save towards retirement. In this lesson, we are going to go through step by step to show you how to calculate your retirement needs, and then what your annual savings goal should be based off of that. After that, we'll touch on institutions that we recommend and also help you determine the right way to prioritize your account contributions. As a side note, this lesson is a little math heavy, so please take your time on each slide. I will walk you through step by step. There are online calculators that you can use in place of this exercise if it does not click for you, but I do believe there's value in understanding the calculations behind your savings goals, which is why I'm showing it in this way. Before we do any of our calculations, we need to start by understanding what your net income is. Let's start by looking at your most recent pay stub. You'll need to determine how frequently you're paid. Many jobs pay 2 times per month or every 2 weeks, and while these sound similar, they're different, so it's important to understand your own pay frequency. Next, you will look closely at your pay stub and locate deductions to your paycheck, specifically anything that you're contributing to an employer-sponsored retirement account. Be sure not to count the deductions that are paid by your employer, as those don't impact your net pay. After you've located the amount that you're contributing towards retirement, this is where the importance of step 2 comes in. There are 52 weeks in a year, so if you're paid 2 times per month, you receive 24 paychecks in a year. But if you're paid every 2 weeks, you'll receive 26 paychecks in a year. To calculate your annual net income, you will take the number that you receive via direct deposit, add back in any applicable retirement contributions to your employer plan, and then multiply that number by the number of paychecks that you receive in a year. You will use that number on the following slide. If your work warrants a different approach to determine your net income, you can calculate this number many different ways. The important thing is that you're looking at your net income, which is the money that enters your bank account, and adding back in any retirement contributions to employer plans. Our first step is to determine the amount that we need to fund annually in retirement. We will start this calculation by writing down the number that you calculated on the last slide, your net income today. I will be using sample numbers to demonstrate this exercise. On the next line, you will estimate your wage replacement ratio in retirement. Many retirees find that their living expenses actually decrease in retirement due to things like no longer commuting to work, buying lunch out, keeping a professional wardrobe, etc. Depending on the lifestyle that you want to live in retirement, you may choose a 100% wage replacement ratio. And there are even some circumstances where you may foresee wanting to spend more in retirement. For instance, maybe you know that you're going to travel a lot and that your expenses annually will be greater because of that. Other people may know that their retirement lifestyle will cost them a lot less than what they're currently making, so perhaps they would only need a 70% wage replacement ratio. Whatever this number is for you, you should estimate what you believe you'll need for your living expenses in retirement. And if you are entirely unsure, 85% is an acceptable estimate that would work for many people. Next, you will take line 1 and multiply it by line 2. Said another way, you should calculate what X% of your income today is, and use that number in line 3. Line 3 is demonstrating in today's dollars what you expect to live on annually in retirement. After that, you should use line 4 to capture the income that you expect from Social Security and any applicable pension. Some people may choose to leave this number at 0 given the uncertainty around the long-term outlook for Social Security. It is up to you whether you would like to include a number here or not. If you would like to calculate what your current expected Social Security earnings will be in retirement, you should visit ssa.gov and create a profile if you do not already have one. If Social Security does not give you an estimate or says that you do not yet have enough credits, it may be the case that you have not yet worked for enough years to know what your future benefit will be. Another important note to make on this item is that Social Security will be different depending on which age you plan to retire. ssa.gov will show you estimates for age 62, 67, and 70. After you've determined what number to include in line 4, you will subtract that number from the needs in line 3. This will bring you to the final number, which is the annual amount you would need from your portfolio each year in retirement, stated in today's dollars. We will use this number on the following slide to begin our calculations. Now is the time to open up an online financial calculator. Please click on this link and open it in another tab, using it simultaneously while going through the rest of this lesson. Here's a preview of what the calculator looks like. Pay special attention to the tabs in the upper left side. In the following slides, we will solve for future value, payment, interest per year, the number of periods, or years in our case, and the present value. For our first financial calculation, make sure that you select the tab FV as we are solving for the future value in this calculation. Using the number that you calculated from the last slide for your annual amount needed from your portfolio in today's dollars, enter that number as a negative dollar amount for PV. Next, you'll enter in the number of years from now until your retirement age. In this example, I am choosing 67 as my retirement age and assuming that the person making this calculation is 30 years old. This means that I would enter 37 for the value of N. Next, we are going to enter in our expected inflation rate. Most financial advisors will use a number between 2.5% and 3.5% to represent a reasonable estimate in the long term. For this example, I'm choosing 3%, so that is the number that I will be using for I/Y. While I/Y stands for interest per year, in this calculation, we are also able to use this value to represent the inflation rate per year. Since we are adjusting for inflation only, we will enter 0 for the value of payment, and then we will click Calculate. The number that is computed using these figures is the inflation-adjusted number that you will need to pull from your retirement portfolio in your first year of retirement. Next, we will be solving for present value, so make sure to click on the tab that says PV. Before you do anything else, expand the settings and change the calculation to beginning mode, as shown in the screenshot on the right. This is used because we want this calculation to reflect the payment to occur at the beginning of the year rather than at the end, since in retirement, this would most likely be the case. Start by entering the number from the final line on the last slide as the payment amount. In this example, that number was $55,227. Next, you will calculate your retirement life expectancy by taking your life expectancy and subtracting your retirement age. In this case, we are assuming that this person is likely to die by the age of 95, and we are using the same retirement age as our previous calculations. 95 minus 67 is 28, so we would use 28 for the value of N, which resembles the number of periods. On this next line, we'll be using the real rate of return for I/Y. This is most likely a new concept for you, so I will explain how to calculate this. To calculate the real rate of return, you will take 1 plus the nominal rate, or the expected performance on your investment, and in our sample we are using 8.5%, which is a historically reliable number to be able to count on over a 30-year period. Some people would even say this is conservative, but it is a good starting place. Next, you will divide that by 1 plus the expected inflation rate, which you may remember on our last slide we used 3%. You will use whatever number you had used in the previous calculation. After you take 1 plus the nominal rate divided by 1 plus the inflation rate, you will subtract 1 from that number that you receive, and then you will multiply it by 100 to express it as a percentage. In the case of an 8.5% portfolio growth and a 3% inflation rate, you can see that the real rate of return on this investment would be 5.34%. Next, you will enter in 0 for the future value, as we are expecting that by the time of death, our portfolio will be 0 or close to that. Once you have entered in those values, click Calculate to view your lump sum target goal. The dollar amount presented here is the amount of money that your retirement portfolio should be prior to your first year of retirement. An important note to make here: this does not factor in taxability of income in retirement. If all accounts are Roth accounts, they will be distributed tax-free. However, if they're traditional accounts, you will need to account for your taxable income in retirement. If you wanted to adjust this equation to factor in the taxability of income, you could adjust the input for payment on this step by increasing the number by the percentage of taxes that you're expecting to pay on your income in retirement. The last calculation that we will do here is to solve for the payment needed annually in order to fund your retirement. Be sure to expand the settings on the calculator once again to deselect beginning mode and change it back to ending mode. Be sure to select the tab that solves for payment. For future value, we will enter in the number that we received as our lump sum target. Then you will enter in the number of years until retirement using the same method as before. Take your expected retirement age and subtract your current age and use that number for the value of N. Next, you will enter in your expected performance on investments, making sure not to include inflation in this number. So as we explained on the previous slide, in this example, we are using 8.5% as a safe long-term estimate for returns and inputting that number for I/Y. Lastly, you will enter in your current balance of all retirement savings as your present value. This may be zero for you if you have no retirement savings. It could be much more, or it might be a small amount. Whatever it is, you should enter this number here and make sure to express it as a negative value for the purpose of this calculation. You are now ready to click Calculate to solve for the payment needed annually to reach your target retirement goal. The number that it computes should result in a negative number, assuming that you used a negative number when entering in PV. If it does not, this means that you have already met your retirement funding goal without adding anything else to it. But for most people, this will give you the annual amount needed to put towards retirement in order to sufficiently fund your retirement goals. You can divide this number by 12 to look at this in terms of a monthly savings goal. Now that you know how much you should invest, you may be wondering where you should invest. On the following slides, we will discuss what to look for in an institution, as well as share a few that we've had good experiences with. As we've discussed in our class principles, fees are extremely important to take note of in your retirement portfolio, as small differences in fees can result in large differences in ending balances. We recommend selecting funds with expense ratios of less than 0.25%. Next, we recommend working with a company who offers good customer service, especially by phone. If you are new to investing, the online process to buy funds can feel confusing, and it's very helpful to be able to make a call to your institution and speak with a real person who can walk you through the process and help make sure that you're doing things correctly. Next, you want to make sure that the company you do business with is transparent about their fees and how they make money. There are many investment companies who claim to be free, but this is never the case. Companies have to make money somewhere, whether that is through expense ratios, trade fees, annual fees, or other. If a company is not transparent about their fees, I would suggest doing business with a company who is. Lastly, you want to choose a firm whose fund minimums are in line with what you are able to invest. For instance, some institutions have $1 minimums, and others have $1,000 to $3,000 minimums in order to buy into certain funds. Make sure that you open an account somewhere that you can buy into a fund, or just plan to use exchange-traded funds until you can invest into an index. Here are 3 institutions that are widely accepted as some of the best investment institutions around. Many of our participants use one of these 3 firms, and they are ones that we stand by personally as well. All of them are notorious for their low fund fees, which is their strongest selling point above their competitors. They also offer great customer service. Something unique about Vanguard is that it is member-owned, which makes it their #1 priority to serve their customers. One downside to Vanguard is that their fund minimum for their target date funds starts at $1,000. Some of their other popular index funds start at $3,000. So if you're starting from zero and hoping to invest into an index fund immediately, you may be better served by Charles Schwab or Fidelity, which both have $1 fund minimums. Charles Schwab is also well known for excellent account options for general savings, so you may choose to go with them over Fidelity if you're hoping to open up other account types as well. The last topic we'll be covering is how to prioritize account contributions. If you have an employer account such as a 401k or a 403b, invest as much as you need to in order to attain the maximum employer match if your employer offers one. After that, you will want to invest as much as you're able to into a Roth IRA up to the maximum annual amount. If you still need to invest more beyond that in order to meet your annual savings goal, you will return to your employer account and increase your contributions until the combined total between all accounts reflects your investment goals. You may not end up using all 3 steps depending on your annual investing goals. That wraps up what we are covering in today's supplemental lesson. Thank you for taking the time to review this learning material, and I hope you found it helpful in understanding how much you should save in order to fund your lifestyle in retirement. If you have any feedback to share, please do so by writing to me at nikita.wolf@thirddecade.org. Have a great day.